Welcome to the Monocle Banking Podcast, where we explore the ideas, the innovations, and the individuals shaping the future of finance. As always, proudly brought to you by Monocle Solutions. I'm Michael Avery, and today we're going to talk about those black boxes called AI models. And I think it's a topic that we'll all agree sits at the intersection of risk, of tech, and trust. And there's a lot of hype at the moment, but let's face it, in banking, we see models all over the place. We've been using them for years. But the big issue is how we manage risk when it comes to deploying these models at scale. Well, our guest is Jos Gheerardyn, founder and CEO of Yield from Belgium, a company that has made its mission to help banks and financial institutions tame the complex, ever-evolving world of algorithms and predictive models. And as Jos likes to say, a perfect model doesn't exist and never will. So today we're going to unpack why that is. Jos, I read that from an interview you gave a couple of years ago. So let's start at the top. And, that statement that a perfect model doesn't exist and never will. Can you unpack it? Is it about the nature of data, the unpredictability of human behavior, or is it the changing context that models operate in?
Hi, Michael. And yes, of course, there is no perfect model. There will never be such a case because, of course, when we are modeling a system, then we always have to make assumptions, because reality is just far too complex to be tractable. And therefore, a perfect model would mean that you are able to incorporate all the assumptions of the real world, which is not possible. So that's why we will always have model risk in one way or shape or form.
Absolutely. So it really is about context, and probably less so about nature of data, but more so about the changing context that models operate in, which we'll come to. Maybe let's just start at the top, because model risk management sounds like a really niche technical field. For the uninitiated, what exactly is what's called MRM, and why has it become such a critical component in modern banking today?
Yes, that's a great question, and thanks for this. Model risk is the risk that an organization takes when they use mathematical models. Now, in finance, of course, mathematical models are used everywhere. So if, for instance, you are selling mortgages, then obviously you need to estimate what's the creditworthiness of your customer. So for this, we are using credit scoring models. And these models try to predict somehow, based on history and all kinds of data, how likely it is would be able to repay that loan. Of course, credit is an extremely important item in financial institutions, but of course, there's many other models that are being used, for instance, to compute the value of derivatives, to estimate market risk, meaning trying to understand what is the impact of adverse market scenarios. There's a lot of activity around fraud detection, trying to identify anti-money laundering scenarios. And there is basically everywhere you look in a financial institution, you will find models. Now, model risk management is trying to manage the risk of using those models. And why is there risk? Well, because as we started the conversation, no model is perfect. Therefore, you should always take into account that the models might not predict exactly or fully accurately the outcome, and you have to take that into account. And that's really the risk that is associated with it, because if you assume that whatever comes out of the model is always going to be right, then clearly there will be cases where you are surprised. In most of the cases, the issues and the accidents that we have seen in the past are not so much related to the fact that there is this inherent uncertainty in the outcome of a model, but it's mostly because people have started to use financial models in a context for which they haven't been designed. A very good example of this is what happened in the credit crisis. So back in 2008, almost 20 years ago by now, what happened is that there were extremely complex derivatives that had been historically priced or valued with a fairly straightforward and simple model with very limiting underlying assumptions. Now, as the market evolved and the derivatives became more and more complex, somehow the models that should have been used didn't really evolve that much. And therefore, at some point, our financial institutions were pricing these complex derivatives with overly simple models, which made them somehow blind for the risk that they were actually taking. And then when things started to fall apart, suddenly there was a huge impact everywhere in the financial sector. So what you can see from that story is that in most cases, the main risk related to using mathematical models comes from the fact that the use case of those models evolves over time, and you should somehow have governance in place to detect this and to be able to mitigate that risk. So that's really model risk management, the management of those risks. And in many geographies, model risk management is a regulatory requirement. And the reason is, of course, that since there have been so many issues happening in the past, the regulators want to make sure that that risk is properly understood and well managed.
And I think in many ways, AI today feels like that pre-2008 world of risk models. It's highly complex, I think poorly understood, and often taken at face value by decision makers. We know AI can hallucinate, and I think there is now rising concern around this. But how has the rise of AI and machine learning reshaped the scope and urgency of model risk management?
Well, actually, as you rightly pointed out, the complexity of AI systems is far greater than the traditional statistical models that have been in use in financial industry for quite some time. So that in itself means that the amount of risk related to using those models increases. I mean, the actual risk that an organization takes will always be somehow proportional to the complexity of the model and to say the black box nature of that. So definitely say the absolute amount of risk per model is increasing due to this evolution towards more AI. But on top of that, the footprint of analytics is increasing at a very rapid pace. So where we would in the past, like 10 years ago, have been primarily focusing on credit risk, market risk, like what I just mentioned in the beginning, nowadays, basically every software application comes already with Gen AI features, and therefore anything that you do suddenly starts to be impacted by model risk because there is AI built in all of those tools, and we need to take into account the fact that those AI can fail. So there's really these two drivers. On the one hand, the number of use cases increases exponentially. And secondly, due to the complexity, the black box nature, the fact that AI systems are primarily developed by external firms, this then drives the amount of risk going up, not only absolutely in terms of, say, the risk per use case, but also just the number of use cases increases quite a bit. And as a consequence of this, we see that AI governance regulation is being drafted in some geographies. However, even without any regulation, financial institutions, of course, need to manage that risk properly because it doesn't only come with financial issues, it can also lead to reputational risk, of course. If, say, you push a chatbot into production and it turns out that the chatbot gives incorrect information, then obviously that's an important issue, given that the tools that we make available for our customers should be trustworthy in itself.
When you look at it, I think one of the biggest critiques after the global financial crisis was that models were built on historical data that didn't account for extreme events. So how does the continuous monitoring and stress testing and validation that kind yields promotes prevent the blind spots that we saw in 2008? If we can build out and develop lessons then for how to deal with this increasing complexity that's brought about by this rise of AI.
Yeah, I think what we are trying to achieve is to incorporate more engineering in the risk management principles of financial institutions. So in the past, people would primarily do, say, manual validation, meaning there would be a standalone team, an independent team who has not been involved in developing the models. So this is called the second line of defense. And that team's responsibility is to verify that the models have been correctly implemented, that they are behaving according to their specifications, that the risks are well understood, that there is documentation in place, and so on. So the traditional type of exhaustive validation where you are trying to fully understand the model is virtually impossible with the rise of AI. If I have created, say, a chatbot and it's built on top of, say, ChatGPT or any of the other big vendors, well, those models are that big, that huge, that it's impossible to fully comprehend how the model is working. So in order to then still try to mitigate the risks of using those models, you have to try to build some guardrails and start to understand better, say, what is typical behavior. The way in which this is done is, for instance, to try to incorporate continuous monitoring of the application so that you can see whether or not that specific chatbot is used again in the context for which it has been designed, or if somehow the user is starting to use it in a completely different way. For instance, if I'm building a chatbot to answer questions on the service desk of my financial institution, well, if I then suddenly see that my user is asking it some recipe for their favorite cookies, for instance, then clearly the chatbot should detect that it's now getting questions outside of its own typical context and therefore should refuse. So introducing this type of continuous monitoring, introducing also larger scale tests around the specific use cases for which the chatbots have been developed, these all require much more engineering. You can't do this manually. You really need a software system that is able to somehow automate a lot of those activities and filter through all of this data in a highly efficient fashion. So incorporating that type of engineering principles from the start is really part of our mission. It's why we are a software company building solutions for model risk management. We are not a consulting company that offers, say, model validation services on demand. No, we really focus on the technology and try to automate as much as possible. And this is a way to mitigate risks, not only traditional model risk, but also more AI-related risks.
And given that Yields was born out of your frustration with the lack of tools to manage model risk, what was that aha moment that made you decide to build a dedicated platform for this problem? How did you go from an idea in 2017 to creating what is now an award-winning software as a service suite?
So quite some time ago, when I started in the financial services, I was working as the head of a team, a quant team, and a trading floor, building models that were directly used by traders to manage the risk of their derivative portfolios. So back then, we had a fairly large team with, say, a lot of supporting activities like IT people who would say full-time be available to make sure that those models are still working as they should. And if something happened, there was always someone available to fix it. So this was a fairly comfortable way of managing models. However, it was already very clear back then that actually building models that need to be reliably in production for a very long time, this is extremely hard and requires a lot of rigor and testing. But back then in the financial sector, I mean, the team was relatively big and there were always people available to fix issues as they would occur. Then later in my career, I actually worked for around 5 years in a scale-up company that was offering demand response services. Now, demand response is an activity on the energy market where you try to help keep the electricity grid in balance by matching demand and generation. So really, how much power is being consumed needs to be exactly the same as the amount of power that is being produced. And especially in the context of renewable energy, it's much harder, of course, to forecast exactly how much wind energy there's going to be. So the classical way of solving this additional uncertainty on the energy market is to connect a gas-fired power plant that works, say, at 50% of its capacity, so it can automatically produce more or produce less depending on the amount of imbalance between consumption and generation. Now, another, say, smarter way of trying to solve this is to use what is called demand response, which means that you make the consumption of energy flexible and you consume more when there is more power generation, you consume less when there is less power generation. Now, back in 2010, doing this was only possible if you could have power consumption at a very large scale. So in the company where I worked, we contracted industrial consumers of large amounts of power, and then we bought basically flexibility to consume more or less depending on the amount of generation. My role was that I was responsible for creating the algorithms that could do this in real time in an automated fashion, because we were offering what is called primary reserve. This means that you have to react extremely quickly when it comes to imbalances. And so I was developing the algorithms to do all of this. Now, with such a large amount of uncertainty, building models that are reliably solving that optimization problem in real time over a very extensive period of time, like a full year, 24/7, every 30 seconds, you would have to be able to reschedule. This was extremely hard. Moreover, as I was in a scale-up company, there was a very small amount of people who would be available for fixing issues. So the issues would actually have to be fixed almost automatically. So we built a huge amount of infrastructure to try to test better, to try to mitigate issues that we could foresee, to also try to learn from issues that happened over the past. And so we were actually building some sort of like real-time model risk management operation as part of our own product. And that was really the moment where I realized that actually there's so many tools being developed to help build models faster, but to keep those models reliably in production, especially in a context where there is a huge amount of risk, for instance, like in a financial services company, this is where there's lots of issues. And this was really the reason why back in 2017, together with a colleague of mine, we started working on yields to build really a platform that can help model developers, but also model validators to improve the way in which they test models and they mitigate risks related to using those models.
And I think it's quite clear, as you've argued, that manual validation just isn't sustainable anymore, given the scale and complexity of modern model inventories as well. When you look at the regulation, regulators like the ECB and frameworks like SI 11.7 have been stepping up scrutiny. Are regulatory frameworks keeping pace with the speed at which AI models are evolving, or are we entering uncharted territory where innovation runs ahead of oversight?
Yeah, well, that's a kind of difficult question somehow. When you look at regulation needs to be relatively high level so that it can serve multiple contexts. And therefore, people always have to interpret the regulation to apply it on their own context. Of course, it's definitely the case that, say, SR 11.7, when it was built, say, like 14 years ago, it wasn't the type of models that we have today were not yet there. So there is definitely some lag between what you are supposed to do to properly manage AI risks versus what you could find in SR 11.7. However, most of the principles basically remain the same. You need to assess if a model is properly created, if it is fit for purpose, if, say, certain controls are in place. The details of the controls or the details of the tests that you have to execute in order to verify if an AI system is operated in, say, the context for which it has been designed. Maybe the nature of those tests are a bit different. However, the fact that you have to have such tests in place hasn't changed a lot since, say, 10, 15 years ago. So I would argue that, yes, of course, there are some details that are maybe missing. However, the general principles remain largely the same. You just need more engineering. You need to fill up the gaps. But that's actually something that organizations should do irrespective of what exactly the regulator asks, because you really want to understand when models are not working as expected. You need to understand what would be the impact if that happens, and people need to be aware of those risks.
I would think in banking, banking is all about managing risk and also dealing with regulation, one of the most highly regulated industries on earth. what role does culture play then in MRM? Do you see a gap between the quant teams who build models, maybe executives who rely on their outputs without fully understanding their limitations?
Yeah, there are definitely a few challenges there. So first of all, indeed, say senior management has an important role to play when it comes to model risk management, AI governance. We also see in the newer frameworks such as SS123 in the UK, there is a lot more emphasis, or there is quite a bit of emphasis on the role senior management has to play this specific technical type of risk management activity. So clearly you need enough expertise and deep technical expertise also in senior management levels to be able to efficiently mitigate that risk. That's definitely a responsibility and some awareness that has to be created to make sure that there is no blind spots when it comes to AI governance and model risk management in general. Another challenge, I think, is the fact that in the financial institutions, we have the classical highly regulated models, so credit scoring models, for instance, that I alluded to earlier today. And these models have been regulated for a very long time. And so you have quite heavy processes in place to make sure that every modification to those models is properly tested, is properly documented, has been validated, and so on. And then now you have often those new AI teams who work in a completely different fashion, who do not have, say, all the historical burden related to heavy regulation. And they might not also have the experience and expertise around what actually is required to satisfy the guidelines and the regulatory frameworks that are in place. And so those data science teams often struggle to understand what exactly is required and how can they remain effective and efficient even if there is a bit more regulatory guidance that has to be followed. So there is that very often if you have multidisciplinary teams, say with say a few risk managers who have already gone through all the regulatory exams and simultaneously you have data scientists who then bring all the expertise related to new technology and new engineering principles. If you merge those two teams together, that's typically a recipe for success when it comes to having the different camps learn about each other and understand better what it actually takes to build AI systems in a heavily regulated environment.
And that's where, this partnership with Monocle is so interesting, which has been positioned as a bridge between strategy and execution, because to your point, sometimes that's where things fall down. So maybe you can just share how this collaboration came about and really what differentiates it from other partnerships in the risk management space.
Yes, definitely. We started talking together because we had a common customer where we were implementing our model risk management solution. It was actually in the UK, driven by SS123. And then we started exploring different routes. And indeed, we do often need support when it comes to implementing model risk management and AI governance software, mostly because we have to somehow often change a bit the way in which an organization works. So there is always, when financial institutions buy our solution, it's often driven by a desire to be more efficient, more effective, to be able to also deal with, say, all the challenges that we have discussed related to AI governance and AI risk management. However, just installing software never solves all of those problems at once. You actually need to also go through an exercise as an organization of maybe a bit more standardization and trying to understand how the processes that you have developed historically can actually become scalable. And once they become scalable, you can also obviously start automating them more efficiently. So in order to do that efficiently, we really need people on the ground or people who can guide the customer through that journey and understand the technology very well, but also understand, say, the vision of the organization of why they want to use this software and help them to find what's the real correct paths towards that goal. And we found out that same Monocle is really helps us a lot and gives extremely valuable advice to our customers as well. So we are now running a few tier one implementation projects, so implementation projects for tier one financial institutions, where Monocle is indeed this bridge between, on the one hand, say, management of our customer, and Monocle fully understands what the vision is, what the ultimate goal is for this specific implementation, but simultaneously, they also understand very well how our technology works. And they bridge that gap really and help the organizations change the way in which they operate to make use of our software.
It's about being able to talk banking and business and tech and speak three of those languages fluently and proficiently. Just lastly, what would your advice to C-suite executives and boards who may underestimate the reputation and financial risks of poorly managed AI be? Because I could see AI governance becoming more of a competitive advantage just than another compliance cost.
Exactly. What we notice is that a lot of the cost of having subpar AI governance principles in place are hidden. For instance, you see a lot of AI projects maybe fail just before they go into production or not deliver the value that was originally promoted. Or you may discover that, say, projects take a lot longer than anticipated. And all of these are often symptoms of the fact that underneath, we don't have the right processes to decide what are exactly the steps that we have to take in order to build a trustworthy, robust AI system. So my suggestion would really be try to uncover some of those hidden costs, try to benchmark how your projects compare to that of your peers. And if you see some mismatch, then dive a little bit deeper, and maybe it's indeed related to the fact that, say, the AI governance principles have not been properly implemented or have not been developed, or maybe have been over-engineered, which is also sometimes happening. And when you discover this, then trying to add some more clarity and transparency often helps in identifying what are the root causes and how to fix them.
Well, from algorithms to governance, Jos Gheerardyn, thank you very much for showing us that the future of financial services depends not just on building smarter models, but really on understanding their limitations and managing those risks with the kind of engineering lens that you brought to this conversation. Thanks so much for joining us on this deep dive into model risk management and AI governance here on the Monocle Banking Podcast. Well, from all of us at the Monocle Banking Podcast, thanks so much for listening. If you've enjoyed this episode, be sure to subscribe, share, and join us next time as we continue to profile the change makers driving our financial evolution. Take care.